Looking back at what happened in March, there was incredible volatility. We saw Treasury yields plumb new lows. You saw opportunities in off-the-run Treasuries. These are older, less traded bonds, which in the best of times, normal times, are tough to trade. What gave you confidence in March that you could take advantage of the situation and not get stuck in a situation where there's an absence of liquidity?
Well, Scarlet, thanks so much for having me on again. I would say the team had a very high conviction that both robust monetary and fiscal policy response would be very supportive of the capital markets and over time of the real economy. And while we still expected the impact from the coronavirus to bleed through pretty much into the second quarter, we felt that the policy response was so robust that it would be supportive of the capital markets and eventually of the real economy. And so we looked for opportunities that existed. Off-the-run securities, which are older, less traded securities, became fairly dislocated. We thought that they offered better potential excess returns. We looked at inflation-protected securities, which were trading in and around a 50 basis point inflation expectation, and thought that the policy response there would also be supportive of the economy and inflation expectations over time. And then it's true to Vanguard. We are very collaborative across the global active team. We reached out to our experts on the mortgage side, and the mortgage team were able to help us boost the returns of the funds by adding very high credit quality selected mortgage-backed securities to the funds as well.
So, Gemma, if you go back to your comment there about inflation, I'm curious as to what sort of underlies this thesis that maybe inflation expectations have maybe gotten a little bit too far ahead, if you will. What are generally your expectations here for prices over the sort of the near to medium term?
Yeah, so over the near term, we do think that the demand shock will continue to persist through the inflation data. So we're looking for very low but very stable inflation for the rest of the year. So inflation in around 0.5% on average in terms of CPI. But we think going forward as the economy reopens, and again, this is predicated on no second shutdown, no second phase of the virus, which are a risk to the forecast. But if we have this slow, gradual recovery that takes better part of the next 18 months, we think inflation will come back with it. So the sectors, the consumer sectors that have been hit in the downturn should mean revert. We think housing will remain relatively stable. And we think that will be enough in addition to the policy support that we currently have and potentially may have in another wave of fiscal stimulus to help inflation slow and gradually mean revert over the next 18 months towards the Fed's target.
So you mentioned slow, gradual recovery. We also have extraordinarily low interest rates, and there's concerns that rates could turn negative as well. If you're a fund with a mandate, a return mandate of 6 to 7%, you're going to have to seriously think about shifting away from this allocation now. How do you see the return profile shaping up over the next few years with rates staying this low and with policy staying this accommodative?
Yeah, well, actually, if you look at the yield on a fund, it will tell you, particularly a bond fund, it will tell you the expected return over time. In the U.S., we have experienced periodically short-dated bills going negative, but it hasn't lasted very long, and that is clearly because the Federal Reserve has indicated that they don't have a preference to move to negative interest rates. Clarita, Powell this week, and the Fed minutes all seem to indicate that they would prefer to use any and all of their other tools, including a new tool potentially of yield curve control to keep the U.S. out of negative interest rates. So we think bond yields should remain positive. They will remain low for a period of time until the recovery is very much assured, and then interest rates we think could move a little bit higher. But again, with the Fed being at the zero lower bound for a long period of time, we wouldn't expect any significant jump in interest rates.
So, a year ago, less than a year ago, we were all sort of pulling our hair out over the inversion of the yield curve. The 210 portion was negative at one point, I believe, in August, and we're now up around 50 in the positive territory. I'm just curious, when you take a look at the steepening that we've seen across the curve, and you look at some of the commentary that we've been getting out of Jerome Powell and some of the other Fed officials, do you think we're going to get to a stage where there is some sort of explicit communication from the Fed about yield curve control?
We do think that they will keep that in their quiver, right? So the Fed chair and in addition the minutes seem to indicate, and even Vice Chair Clarita today seem to indicate that they'd like to see the evolution of the economy, and this will take some time. So our best estimate would be that sometime around the third quarter, end of the third quarter, beginning of the fourth quarter, the Fed will have hopefully a clearer roadmap of where the U.S. economy is going, and they will make a determination of whether they need to shift and refine their policy. And that could include, forward guidance, date-based forward guidance. It could include yield curve control. It could include some combination of that. It could also include skewing their purchases, which have been pretty even across the yield curve and maturities at this juncture, skew them towards one end of the curve or the other. So if interest rates should become too high before the economy is fully recovered, they may dampen the rise in interest rates by buying more longer-dated securities. So we'll have to see how that mix plays out, but I do think yield curve control is potentially a new tool for them. But right now, forward guidance seems to indicate that they have a preference for keeping interest rates at the zero low bound for a very long period of time.